Welcome back. The market is, I have to say, struggling a bit, at least as far as the indices are concerned. You've got just about 25 points left on it. And we're at 25,040. So steep climb down, 200-point climb down from the day's high, which was, of course, pre-noon. Alok Agarwal is with us. He's fund manager at Alchemy Capital. Alok, good afternoon. Good to have you here. Prashant this side. And I was looking at your portfolio, Alok. We can talk about the broader market. Maybe just a quick word on some of your top holdings. I think Trent is right up there as one of the top holdings, and must have made you and your investors happy, depending on when you got in. But for those who don't already own it, what's the view from here, Alok? With the disclosure that, of course, it's your top holding, so I think that's a given. New entries into new segments like lab-grown diamonds with this new brand. Just talk to us about what your thoughts are.
Sure, Prashant. I think the way this particular management has executed is really par excellence. And what they did with the turnaround of the West Side and thereafter Zudio, which was a small part of Star Bazaar earlier, and then bouncing back and almost spreading to the whole country like almost wildfire, growing at a super fast pace. And even the profit growth of the company for the last 3 years in the CAGR of close to 50% or so. And with their latest announcement around lab-grown diamonds, and if they can do further things on the Star Bazaar format as well, they have shown their execution. The market likes the execution. The numbers are getting reflected in the financial statements. Nobody can be complaining. Of course, the valuations are on a higher side, and the stock has done well. So to that extent, if there are rewards, if there are visibilities, there is a price to be paid for that as well. So we have been holders for a pretty long time and quite happy investors out there. But at the same time, the company is doing the right thing, generating cash flows out of the existing businesses, growing them, and finding ways and avenues to invest them more profitably as well. That's what calls for a much larger moat, much larger growth juggernaut to continue.
All right. Hi, Alok. Good afternoon and good to see you. What are you making of Nestle? All through the trading session, the stock has been under pressure, and a couple of these FMCG names as well. ITC is down, Nestle is down. Nestle, I guess the street is sniffing weak results. There have been some selling across staples, and I think, the Maggi sales, people are not too optimistic, at least for the past quarter. Some of these are quality franchises, but what would you do? Would you look to buy into some of these FMCG names on a dip? And what's your preference, staples or discretionary?
Nigel, we are more of the growth investors, I would say. And if we look at the FMCG basket as a whole, they are trading at an all-time high valuation of close to 45 times on a one-year forward basis. And the earnings growth are actually struggling to even hit double-digit mark. So, on a very low growth to pay a very high valuation, it's a combination that doesn't work too well. At the same time, we know as per the narratives as well, especially post-COVID in India and in most of the countries abroad, we saw a K-shaped recovery where the top 5-10% of the population was better off, but the broad-based recovery wasn't there in terms of helping the consumers downtrodden as well. So we are seeing lower volume growth, lower earnings growth for a lot of these companies. No doubt they have been quality franchises. But we've got to also realize that over the last 15, 20 years, the cycles shift. What was an investment-led growth in the first decade of the century, in the previous decade, it was largely a consumption-driven growth. But all signs are pointing toward that we are more in a capex-driven growth kind of a cycle, wherein these companies are trading at higher valuations with low growth, and hence drives our underweight stance on these companies.
Okay. So just sort of looking ahead and the sector rotation that's played out, what is the call on some of the capex plays in manufacturing, PSUs? Because up until, say, August or so, it was this side of the market that was sort of leading the rally. What is your stance here now?
In the middle of that sector rotation continuing, we have to bear in mind that for a long period of time, from 2007 calendar year end till about, say, 2020 and just after COVID, for a 13-year period, domestic cyclicals put together, their market cap as a cohort had barely risen. at a time when the indices had gone up 3 times, at a time when the nominal GDP had grown close to 3 times, as a cohort, domestic cyclicals did virtually nothing. But that doesn't mean they need to bounce back. The focus was coming back right from the government side. The investment to GDP ratios in India, which were at the highs of around 36% in FY12, we had gone down to a 2-decade low of around 26% or so, 27% in FY20. We are bouncing back now. We are above 30%. And going by the announcements and the resolve of the government and the private capex also is showing signs of pickup, we do expect that the capex-driven rally is likely to continue. We do see that there was in the near past, especially post the election and the budget and the near few months, there was an unintended kind of policy tightening. We expect this to pivot back into capex mode. The domestic balance sheets in terms of corporate balance sheets have been pretty strong. If you look at the Nifty 50 or the Nifty 100 kind of ROEs, they are at more than 10-year highs. The government balance sheet is super strong. The balance of payments continue to be strong. The reserves are good. All the makings, the building blocks required for capex to continue are all there. It's a long runway of growth. There will be speed bumps like the ones that we saw in the last 2-3 months to come through. But yes, we are probably in the middle of that longer term capex to play out.
Okay. So Alok, on earnings, I mean, given that that's the next litmus test the market is running into, I think the expectations are running very low from this quarter already. I think the overall sense is that we'll probably see a moderation. But are you expecting this to be a temporary patch, or do you think earnings could become a headwind that the market has not yet factored in?
It's a mix of both, Surabhi. I would say that when we started off the financial year, it looked like that 15% kind of earnings growth for each of these 2 financial years would come through. In the first quarter of this financial year, we saw a low single-digit kind of earning growth. And this quarter also, the expectations are on a lower side. We got to also understand what happened in the last 2 years. In FY23, the revenue growth was good, but due to Russia-Ukraine war, high commodity prices, we had low margins and a low earnings growth. On the back of low earnings growth of FY23, we saw a big margin jump in FY24 and hence a good growth as well. Now FY25 is on the back of a very high growth that we saw in the last year. We do see some moderation to happen, but from FY24 to 26 over a 2-year period, the larger indices are likely to post the consensus estimates are also pointing towards 12-13% kind of annualized growth, which is not bad at all. But also we want to bear in mind that a lot of these larger indices are hogged by those sectors that had done well in the previous cycle, which were more on consumption-driven sides. A lot of the capex-driven side, the manufacturing-driven side, are not really fully present in the main indices, the likes of premium real estate, the likes of defense, the likes of power, the likes of railways, the likes of EMS. These sectors are the ones that are seeing larger growth, but they are kind of underrepresented in the main indices.
Okay, no, absolutely. And, it's a point taken. By the way, Alok, any sort of view near medium term on markets themselves? Any strong views on where we are headed? Because we're down, 250 down now from the day's high.
Yeah, I think, Prashant, I would say to the extent that the indices, for the day, it's difficult to comment. But if you look at the last month or so, while the indices are barely 5-7% down, if you look at the BSE 500, more than half the stocks are more than 10-15% down from their highs. So the broader market was already showing some signs of correction. The current ones, as we can see, some of the heavyweight index sector indices are the ones that are correcting, that are leading the whole market down. The broader markets aren't as weak today as well. So we are seeing some of the sector-related moves coming through. We are more on the positive side, although we understand that the valuations aren't exactly cheap. But the kind of growth that is coming to be expected in India in terms of nominal GDP of 11%, even a subdued earnings growth of 12-13% is kind of world-beating kind of growth. So we are on a side that we do expect that the markets are likely to be buoyant, likely to remain good, but we are quite selective in our approach. Just because a sector or a certain market cap hasn't done well, that doesn't invite us to go there and invest there until unless there is growth visibility. That's the kind of debate, that's the kind of dichotomy the market offers as of now. And we are believers where we invest into visibility of growth.
Okay, Alok, we will leave it on that note then for today. Thank you very much for joining in and giving us your perspective on the market as we speak.